Welcome to Taxation Chapter 2. On the next slide, we're going to talk about the main topics in this chapter. In this chapter, we're going to look at filing and payment deadlines for persons. Now remember from the earlier chapter, persons are individual, corporations, and trust. Now the filing deadline is when the tax return is due, and for individuals, it's referred to as a T1 tax return, corporations T2 tax return, and for trust T3. Now, the balance owing due date may be different from the filing deadline. The balance owing due date is when the final payment of taxes is due for persons. On the next slide, let's focus on individuals. Now, for individuals, the filing deadline for their T1 tax return is April 30th of the following year. Now, that gets extended to individuals that have an unincorporated business, that are self-employed, or consultants that have self-employment income. Now, this would apply to that individual along with their spouse or common law partner. So the couple would be able to file by June 15th of the following year. Now, once again, this is just the filing deadline. The balance owing due date, if the individual owes any additional taxes, is due April 30th of the following year. Moving on, for individuals that are deceased, the filing deadline is the later of two dates. The regular filing deadline, that would be April 30th or June 15th of the following year, or 6 months from the date of death. So let's look at this example here. Let's say Sally dies on February 14th of the 02 year. When is her 01 and 02 T1 tax return due? And let's say Sally only has pension income. So see if you can solve this answer and pause the video now and then resume it once you're ready to check your answer. So let's take a look at the answer. 6 months from the date of death would be August 14th, 02. So she died on February 14th, so we add 6 months, that would be August 14th, 02. So the 01 tax return is due August 14th. Now the later of two dates, the regular filing deadline for the 01 tax return would be April 30th, 02. The later date is 6 months from the date of death, which is August 14th, 02. Moving on, let's look at the 02 tax return. Now the 02 tax return, the regular filing deadline is April 30th, 03, which is later than 6 months from the date of death, so that would be the filing deadline for the 02 tax return. Moving on to the next slide, for individuals, some individuals are required to make quarterly installments during the year for the current year taxes. Now, quarterly installments are required if, one, the net tax owing for the year is greater than $3,000, and for either the current year and either one of the previous 2 years. So let me just repeat that. Quarterly installments are required if the net tax owing is greater than $3,000 in the current year and either one of the previous 2 years. Now, this is to make sure that those individuals that are, let's say, self-employed also pay their taxes throughout the year as employed individuals do. Employed individuals that work for an employer get taxes taken off every paycheck, so those that are self-employed that don't have an employer to take taxes off their paycheck, they have to make quarterly installments during the year. Now, when are quarterly installments due? They're due on March 15th, June 15th, September 15th, and December 15th of the current year. So what is net tax owing? Net tax owing is the total federal and provincial taxes owing for that particular year minus any taxes withheld. Taxes withheld would be, for example, the taxes that the employer withholds from their employees' paychecks. Now, look at the statement at the top. It's an and statement. So that means that both conditions need to be met in order for quarterly installments to be required. Moving on to the next slide. There are three alternatives to determine what the quarterly installment amount should be. Alternative one is looking at the current year net tax owing, and because we're talking about the current year, that's going to be based on estimates. Alternative two is looking at last year, the preceding year. Alternative 3 looks at the second preceding year, so 2 years ago, and also last year as well. Now, when we go through an example, we'll see that both alternative 2 and 3 result in the same total installments over the year. However, the timing of those payments and the payment amounts will be different. If an individual happens to select alternative 1, and the estimates that taxpayer makes are too low, then the CRA could assess interest on insufficient installment payments. Now, given all three alternatives, the taxpayer is able to select any of the three, but once again, because alternative 1 is based on estimates, if the estimates are too low, that taxpayer could be charged interest for insufficient installments. Let's look at this example on the next slide. We have Devin, who's a taxpayer, and we have Devin's current estimated taxes last year preceding and 2 years ago second preceding. So let's just sort of take a look at this. Are installments required? Is the net tax owing greater than $3,000 in the current year? Yes, it is. And either of the 2 preceding years? Yes, they are. So either one of the 2 preceding years is greater than $3,000. The preceding is greater than $3,000. The second preceding is not. It's only $2,000, but it's an either statement. So that condition is also true. So let's make a note of this information before we move on to the next slide to determine what the 3 alternative amounts are. So on the next slide, alternative 1. The current year net tax owing is $6,000. We divide it by 4, so the quarterly installments are $1,500 each. Pretty straightforward. Alternative 2 is based on the preceding year. The preceding year's net tax owing was $5,000. We divide that by 4, so $1,250 per installment. Now, alternative 3 is the one that the CRA uses, just because they don't have all the information readily available. So for installment 1 and 2, they go back 2 years, and in that 2 years ago, the taxpayer had net tax owing of $2,000. Divide by 4. So for the first 2 installments, it's $500 each. Now for installment 3 and 4, by that time, the CRA will have last year's or their preceding year's net tax owing, which was $5,000. They're going to subtract the total of the first 2 installments. Remember, it was $500 each, so the total of the first 2 is $1,000. So there's still $4,000 owing for the last 2 installments. We divide it by 2, so there's going to be a $2,000 installment due for installment 3 and 4. Now, once again, installments 2 and 3 result in the same total installments, which is $5,000 total. But because of the time value of money, alternative 3 would be the better choice. And because this is also the CRA method, if you choose the CRA method, then you wouldn't be charged any interest for insufficient installment amounts. Moving on to the next slide, let's look at corporations. Now, corporations have a filing due date that is 6 months after their fiscal year end. And remember, a fiscal year end could be any date. So a corporation can choose any 12-month period as their fiscal year. So in this first example, if the corporation's fiscal year end is March 31st, then their T2 corporate tax return is due 6 months later, which is September 30th. Now, the due date for any balance owing is 2 months from the fiscal year end. So once again, if we have this corporation that has a fiscal year end of March 31st, 2 months from that, May 31st, would be when they have to make their final payment of taxes. Now, monthly installments, not quarterly, monthly installments are required for corporations if the estimated current year or prior year taxes payable is greater than $3,000. Now note, this is an or statement, so either one of those conditions if either one of those conditions are true, then the corporation needs to make monthly installments. Now there are also 3 alternatives for calculating the installments: the current year, the preceding year, and the second and first preceding year, similar to that of individuals. The difference is that for corporations, they don't get any tax withheld, so it's just the total taxes that were payable that we're going to use. And once again, these are monthly installments, not quarterly. So let's look at this corporate example here. So we have Rick Corporation that has a December 31st fiscal year end, and these are the taxes payable for the current year. Remember, the current year is just an estimate, the preceding year, and the second preceding year. So are installments required? Yes. The current year taxes payable is greater than $3,000, or last year's is greater than $3,000. So in this condition here, both are met, but only one had to be met in order for the statement to be true, because once again, this is an or statement. So moving on to the next slide, let's look at the three installment calculation alternatives. So alternative one, we take the current year taxes owing. We estimated that to be $60,000 divided by 12, so $5,000 installment per month. Preceding year, $66,000 divided by 12, $5,500 per month. Now, the second and the first preceding year alternative, this is the method that the CRA uses just because they don't have all the information readily available. So for the first two installments, they go back 2 years. 2 years ago, taxes payable were $72,000 divided by 12. So for installment 1 and 2, $6,000 each. That's going to be a total of $12,000 for the first two. For the last 10 installments, numbers 3 to 12, we take last year's taxes, which was $66,000, minus the amount of the first two installments, $6,000 each, so a total of $12,000, and we divide that evenly over the remaining 10 payments. $5,400 for the remaining 10 payments. Now, once again, just like for individuals, the last two alternatives will result in the same total installments. However, the timing and the amounts of each monthly are different. Now, in this example, the best alternative for the corporate taxpayer would be the current year. The current year will result in the lowest amount of installments. Now, once again, because it's based on estimates, if the estimate is incorrect and too low, then the CRA may assess interest on insufficient installment payments. For installments, they're due the last day of each month. So once again, if a corporation has a fiscal year end of December 31st, then the current year installments are due January 31st, February 28th, etc. Let's move on to the next slide. Now, there are some exceptions for Canadian-controlled private corporations, CCPCs. CCPC is a private corporation, so it's not a public corporation, it's not traded on a stock exchange, and it's controlled by residents of Canada. So it cannot be controlled by non-residents or public corporations or a combination thereof. Now, there's also a definition of what's called a small CCPC. And once again, you can check your textbook for that definition. Small CCPCs, meeting that definition, are allowed to make quarterly, and that should say instead of monthly installments. So they're allowed to make quarterly installments instead of monthly installments. Certain CCPCs can also have a due date for the final payment of taxes due 3 months from fiscal year end, not 2 months. Moving on to the next slide, there are a bunch of other topics in your textbook that you can read on your own and do the related exercises. Those relate to trust, notice of assessments. Notice of assessment is the CRA's sort of notice that they send the taxpayer to confirm or vary the tax return that was filed. And notice of reassessment, if there's changes to the original notice of assessment, let's say due to a tax audit, then the CRA will issue a notice of reassessment. And once again, that would result from, for example, if there was a taxpayer requested adjustment to an original tax return or a CRA audit that changes the results of the original tax return. Moving on to the next slide, one of the next topics is disputes and appeals. So what if a taxpayer disagrees with the CRA assessment or reassessment? The first step is to contact the CRA and make an informal request. Explain why the taxpayer disagrees with the assessment or reassessment notice, and hopefully that will resolve the matter. If not, then a formal request, filing of a notice of objection, could be done. Now, for individuals and testamentary trusts, the notice of objection needs to be filed by the later of 90 days from the date of the notice of assessment or reassessment, and 1 year from the filing due date. So let's take a look at an example. Let's say Rose, on September the 1st, 2020, receives a notice of assessment that is dated August 26, 2020, and this is for her 2019 T1 return. Now, her only source of income is self-employment income. So using the rules that we just talked about, when is the latest Rose could file a notice of objection? So pause the video here, and then once you have your solution, resume the video, and then compare your solution to the next slide. So pause the video now. Okay, let's look at the solution. Now, the notice of objection is the later of 90 days from the date of the notice of assessment. And so 90 days from the date of the notice of assessment would be November 25th. Now, the later of that date and 1 year from the original due date. Now, because Rose is self-employed, her filing due date is extended to June 15th, 2020. 1 year from that would be June 15th, 2021. So the later of those two dates would be June 15th, 2021. Moving on, corporations and inter vivos trusts have a different due date for the filing of the notice of objection, and it's just a standard 90 days from the date of the notice of assessment or reassessment. So let's take a look at this example. ABC Corporation has a December 31st year end, and for their 2020 T2 tax return, they received a notice of assessment dated October 15th, 2021, and that was received on October 20th, 2021. So when is the latest date for filing the notice of objection? Pause the video, come up with your solution, and then compare your solution with the answer on the next slide. So pause the video here. So let's take a look at the answer. Corporations must file the notice of objection within 90 days from the date of the notice of assessment or reassessment, and so that would be January 13th, 2022. Now, there's also further appeal procedures. If the notice of objection is filed and the resolution is not to the satisfaction of the taxpayer can go and file further claims through the Tax Court of Canada, Federal Court, and ultimately the Supreme Court of Canada. Let's move on to the next topics: tax planning, tax evasion, and tax avoidance. Now, tax planning is basically ways that are to reduce or minimize one's taxes that are consistent with the intent of the income tax laws. For example, RRSP deductions. If Canadian individuals contribute to a registered retirement savings plan, then those contributions could be deducted in the current year to reduce their income, therefore reducing their taxes. So that is a consistent way of tax planning to minimize your taxes in the current year by contributing to an RRSP. Now, with RRSP deductions, you do get taxed on the income when that individual takes the money out of the RRSP. So you don't pay the taxes today, but you pay the taxes later on when the money is withdrawn. So that is known as tax deferral. The individual still has to pay taxes, but it's deferred until a later point in time. So that's an example of tax planning. Moving on to the next slide. On the other end of the spectrum is tax evasion. Tax evasion is deliberately ignoring the tax laws. So an example of that is claiming personal expenses and you're deducting them on your business income. And another example is you're not reporting income. Some individuals make cash sales, they get cash from their customers, and they don't issue a receipt, and they don't report the income. Once again, that is considered tax evasion. Now, in between tax planning and tax evasion, there's this area called tax avoidance. Now, tax avoidance is this fuzzy area, and it's not quite clear, whether tax avoidance is wrong or not. Now, tax avoidance in some instances is fine. For example, tax-free savings accounts. Tax-free savings account is an investment vehicle where an individual can make a contribution into their tax-free savings account, and any earnings within the tax-free savings account is free of tax. So all the earnings within an individual's tax-free savings account, whether that be from interest income, dividend income, capital gains, all of those earnings are tax-free. So that's an acceptable way of avoiding tax. Now, the CRA has a weapon that they can use to tackle transactions that they consider tax avoidance, but that are not inconsistent with the intent of the Income Tax Act. And that's referred to as the General Anti-Avoidance Rule, also known as GAR. And so GAR is used by the CRA to deny tax benefits on certain transactions or arrangements where there's no bona fide non-tax purpose. So what that means is that if a corporation sets up a series of transactions and there's no business purpose other than to obtain tax benefits, the CRA could invoke the GAR rule and try to deny the tax benefits. Once again, for every chapter, do the textbook questions for extra practice. And if your instructor has assigned additional exercises and problems, make sure you work on those as well. And always important to read the entire chapter. So that wraps up Chapter 2. Good luck with your studies, and we'll see you in the next chapter tutorial.